I'm Don with Mercer Partners. Delighted to have everybody for, as it turns out, this very timely, time to be together and share some perspectives. So our whole goal is to be communicating and helpful with, information that affects, all of what we do for you and how we interact with you, and kind of give you some insights that are something other than the financial headlines, which um, sometimes we get a very different perspective when we're dealing with the pros, but we're delighted to be here today. And I'm going to turn it over to Nick on the Mercer team to introduce our presenter and get us going.
Well,
Nick.
thank you, Don. We're very excited to be hosting this very timely webinar today. Thank you, everyone, for taking some time out of your day to join us. Um, Before we get started and introduce our featured speaker today, just a few housekeeping items. We are recording, as Don mentioned. We just definitely want to highlight that. We are recording this presentation. Uh, Part of our compliance to be able to record it and then send it out to anybody that wants to watch the replay. Because of that, we have to disable the chat feature. So chat is disabled, but we are absolutely want your audience participation. So if you'd like to ask a question, we're here for you. We want to hear from you. The best way to do that is through the Q&A feature. Bryce, I know I'll introduce him here in a moment, but he's very excited to take your questions. So we will do that after the presentation. And then also, you can also raise your hand and we can unmute you, and you can ask verbally if you'd like to go that option as well. But chat feature is disabled. So just wanted to make everyone aware of that. So without any further ado, allow me to introduce Bryce Gill, back by popular demand, our returning champion. For many of you may remember, he was with us back in October. We wanted to have Bryce back with us again. Obviously, a lot to digest, a lot to going on in the markets right now. So we thought this would be very timely to bring in Bryce Gill from First Trust on the economics team. He's responsible for helping analyze the economy, bringing perspective to folks, like Don mentioned, maybe beyond the headlines to, what's really going on in the macro economy. So we're very excited to have Bryce with us. So Bryce, without any further ado, welcome. Thank you for being here. We really truly appreciate the partnership with First Trust, and I'll turn it over to you.
Awesome. Well, thank you, Nick. Thank you, Don, for having me back. It's great to be with you guys. And things have been kind of chaotic in the stock market. Obviously, we had briefly touched like a bear market. Since then, things have cooled off, right? Tariffs have been paused. The market's bounced back. I honestly sort of love the chaos that's been happening because it gives me an opportunity to talk about what I think is like the most interesting thing going on in the world, which is the restructuring of like global supply chains and everything. So I definitely want to get into that with you and your clients, and we'll talk tariffs and reshoring and like what the actual impact of all this could be on US GDP. But I do want to start by saying, it seems to me like these corrections that we go through in the stock market, like they just feel worse and worse. And like big picture, guys, hey, a 20% correction, you look at the market history, that happens every 2 years or so, right? It's not abnormal to see something like this occur. The past couple of years in the industry, we've all kind of bemoaned the fact that it's been seven stocks that have driven everything. The market's been hyper concentrated. Diversification hasn't worked at all, right? And heading into this year, just based on a lot of the fundamentals that I think a lot of people were ready to throw away, right? The market just did look frothy, I think, objectively speaking, right? It was sort of expensive, and it was expensive because a small number of stocks were really expensive, okay? And so, in some ways, I kind of see the correction that we had as healthy here. When you look at like the other 493 stocks that aren't like the Mag 7, right? I think they're up slightly on the year, right? So generally speaking, I think what we're seeing is like a rotation trade, where the breadth is like widening out here. We obviously had a correction, guys. I think tariffs are a central part of like the narrative around this correction. and the negative impact they can have on the U.S. economy. And I'm going to touch on all the details there. But just to give you my personal view as we sort of head in here up front, I just think we came in the year as overvalued. I think the market was priced to perfection. And when that's the case, the reality is like any type of new uncertainty that hits can cause what we saw to happen, right? So I'll talk through tariffs. I will give you guys all the detail on that. I'll talk through the real economic impact tariffs can have. But my general opinion is I think tariffs were maybe a catalyst here, but the market was just kind of overvalued headed into this year on like an index level, right? There's a lot of stocks that were still a bargain. And hey, diversification still works. I think that's sort of the good news that's coming out of all this, at least in my opinion.
So
So with
Bryce,
that said, guys,
well, I was gonna,
let's get into the tariff talk and the trade talk because I mentioned this is kind of what I think is the most interesting issue going on in the world. And you know, the reality is Donald Trump putting all these tariffs on, partially it was like kind of widely expected, right? He did his first term in office. But he did go bigger and kind of wider than a lot of people expected. But I'll preface all that by saying we've been seeing a ton of stuff happening on U.S. trade, U.S. supply chains since COVID, really. The Biden administration was, they never removed any tariffs, right? They actually added a lot of restrictions. So I see a lot of like what the Trump administration's doing is sort of a natural progression of what's already been happening. I'm not here to talk about the politics of everything, guys. It's just not my expertise, right? What Donald Trump's going to do with negotiations. Is it 5D chess? Is he just kind of making it up as he goes along? I just want to give you the big picture and some hard data to kind of make sense of all the chaos, right, and all the noise. So with that, I'll go ahead and share some slides. We'll talk through what I think's been going on here, big picture, add some context to the situation we've seen with markets, and then as Nick said at the end, guys, we'll have time for Q&A. I'm happy to take questions on anything. It does not have to be about tariffs. I'm sure a lot of people are kind of sick of the subject at this point, right? It's been a crazy 2 weeks. But I do think there's some good data and some good context here. A lot of people probably haven't heard. So that's the kind of value I want to add here. So guys, I'll start out by saying, we've seen huge shifts in global trade and supply chains really in the past like 2 or 3 years. Dramatic shifts, okay? And I like to say the past 30 years pre-COVID was the biggest boom in globalization in modern history. Okay, the reality is like the Soviet Union collapsed. We united North America in the biggest free trade zone in world history at the time, which is NAFTA. And then China joins the WTO and they bring like 1 billion people in their labor force with them, right? So we got access to a ton of cheap labor and materials in a really short period of time. And by the way, it was at a time when we had like the internet and standardized container shipping to arbitrage everything and coordinate everything, right? And so what you saw the past 30 years was a lot of outsourcing, a lot of globalization, a lot of companies in the United States moving the factory abroad to take advantage of cheaper labor costs, okay? And so if you can cut your labor costs by 90% by moving the factory to China, it's obviously going to be really good for your profits. I think a sort of less discussed part of this is really good for inflation rates as well, right? You can pass on the cost savings to the end consumer. So I don't think it was Paul Volcker and high interest rates that fixed inflation. I think globalization was a central part of that. But the trade-off to all of that is, hey, your supply chains are going to get really long and complex. They might be efficient, right? But they're going to be fragile. And you're also going to deindustrialize as a country, which presents certain like geopolitical risks, okay? And so, COVID-19 comes along and just completely upends the whole apple cart. And so, I just to show you kind of what's been going on, the chart on the screen that I have here, this is U.S. factory construction data, okay? And when you look at this chart, what you see is from like the 1990s through COVID-19, basically nothing really happens with factory construction in the United States. Maybe it trends up a little bit, right? But it's basically flat. Donald Trump gets elected, 2016, right? Factory construction kind of just trends sideways. We don't see like an explosion of reshoring under Donald Trump's first term in office. It's really COVID-19 that hits, gives us the worst supply chain crisis in a generation, probably since OPEC, right? And it changes the whole status quo around trade and basically makes reshoring a bipartisan issue. Okay, the Democrats and the Republicans under President Biden passed the CHIPS Act, the Inflation Reduction Act. The Biden administration left all of Trump's tariffs in place. They actually added restrictions on exports of certain semiconductor manufacturing technology to China, for example. So, hey, I guess we continue down this road of like protectionism and trying to reshore critical elements of the supply chain. Okay. And so what's happened is in the past 2 years or so, post-COVID, factory construction in the United States has tripled. All right, so this is the biggest upward shift in factory construction probably since the Great Depression, when we had factories going up to for the war effort, for example. So it looks to me like we are already becoming more self-sufficient. There's already a factory slash reshoring boom going on. By the way, this doesn't include all like the data centers and warehouses and everything else for the AI revolution in this data. It's just factories like semiconductor fabs and things of that nature. It already looks to me like we're trying to reindustrialize at a pretty rapid pace here. We're becoming more self-sufficient. Now, there's obviously trade-offs there, right? If cheap labor made inflation 2%, the past 30 years, if we're going to reshore everything and pay Americans to do it, there's probably going to be a trade-off on inflation there. Okay. But big picture, there's already a giant bipartisan push to reshore going on before Donald Trump was reelected and added all these new tariffs. Okay. Generally speaking, both political parties in the United States are on board with reshoring. They just sort of have like different ways they want to go about doing it. So the Democrats sort of favor what we'd call industrial policy. So that's the CHIPS Act, the Inflation Reduction Act. Essentially, you give explicit subsidies to companies to reshore production. Okay. And it's pretty targeted in nature, right? The problem with industrial policy is not that it doesn't work. It clearly works. I think if you look at this chart, it shows that. The problem with industrial policy is that, in the United States, we currently have a really bad budget situation going on. It's because interest rates went up, interest costs have soared, right? And so industrial policy is just really expensive. It's going to cost about $3 trillion over, 10 years or so for the CHIPS Act, the Inflation Reduction Act. And that's why I think you're starting to see tariffs become a bigger part of the conversation, is because you can change production incentives, but you can actually do it while taking in money to the U.S. Central Treasury, right? So I think that's one of the reasons why Republicans sort of favor this route. Now, just to kind of show you what's happened with tariffs over time, I've got 200 plus years of tariff data on the screen here. I won't go through the whole history right now, but we could probably just spend an hour on this chart. It's a pretty fascinating story of everything that's happened. But you see the giant surge in tariff rates, and those just include everything that's happened since April 2nd. And obviously, a lot of those have been paused, and there's various other kind of components to that. But you can see how much it surged in like a 1 year time period, right? It's back to where it was in the late 1940s. There's a lot of concerns around these tariffs causing a recession in the United States. If anybody watches the financial press or reads a lot of financial news, you've probably heard of this time period being compared to like the Smoot-Hawley tariff in the 1920s. And so I want to give you guys at least a little bit of good news, okay? I think the United States economy is frankly structured to be pretty resilient against a trade war, all right? What do I mean by that? Well, back in the 1920s, when the Smoot-Hawley tariff goes into effect, and that leads up to the Great Depression, by the way, and a lot of people think it's part of the cause, the United States was a manufacturing country and an agricultural country, okay? So those are the two big things that we basically did here. On top of that, we were supplying the Europeans in the war effort. The U.S. exports were a huge part of our economic engine. We're kind of like China or Germany are today. Right, we're exporting to the rest of the world. That was a huge part of what we did as a country. And so when, the war ends and those export markets disappear, all of a sudden, a big source of your economic activity is essentially disappearing. And so a lot of people look back at this period and say, hey, trade barriers are going up. World trade's kind of falling apart. It puts us at risk of like another major recessionary type event, okay? And since the 1920s, the United States economy has changed dramatically, okay? Today, we are not an exporting country. We're a consumer economy. We're the ones that actually buy everything from the rest of the world. And when you look at U.S. consumer demand, okay, it's mostly based on something called services. And consumer spending is the biggest single component of GDP by far. It makes up about 60-70% of GDP. Okay, when you look at consumer spending in the United States, 70% of consumer spending is services. Okay, so services are me getting on this WebEx and doing a call for you guys on the economy, or Nick and Don giving you financial advice, or Microsoft selling you Office software, or getting a haircut, or going out to eat. Right? These things are provided domestically by Americans to other Americans. They're not really touched by tariffs. Okay, the other 30% of consumer spending is on goods, but only about a third of those goods are actually imported goods. And so at the end of the day, we're talking about 10% of consumer spending that's even exposed to tariffs of any kind, right? It's a pretty small overall chunk. And when you look at like that 10% of consumer spending, what you notice is, hey, actually a huge chunk of that's exempt from tariffs even before all the delays that have happened over the past like week or so. Okay, so about a third of our trade in the United States comes from North America. So it's Canada and Mexico. And I know there's a lot of talk about 25% tariffs on Canada and Mexico. We're talking about tariffing energy imports. We're talking about tariffing auto parts. And generally speaking, like we're negotiating within North America on what we want to do with trade. Okay. But the vast majority of trade crossing the border between Canada, Mexico, and the United States is tariff free today. Okay. The vast majority. Basically, anything under USMCA classifications is not tariffed at all. It's duty free. It doesn't get hit by those 25% tariffs. What gets hit by 25% tariffs is anything that doesn't meet USMCA classifications. And USMCA, guys, that's just NAFTA 2.0 is the way to think about it. Okay. So I'll give you an example. Say a Mexican company is building the doors for a Ford F-150, and they're selling that door to Ford for $1,000. Maybe 50% of the content on that door is from North America, and then maybe they're importing like wiring and hinges and everything else from China, let's say. Okay. The amount that gets tariffed at the border is not the overall $1,000 in the door. It's just the percentage of the content that's from outside North America over a certain like arbitrary sort of limit, right? So, maybe the wiring and the hinges are over that limit. They add $100 to the cost of that $1,000 door. That's what's getting tariffed at 25%. That's $25 to the cost of the door, not $250. Okay. Avocados coming from Mexico are entering duty free because they're fully grown and made in North America, right? So it's a way to kind of think about it. Most of this trade is actually duty free between North America. You remove that portion, we're down to like 7-8% of consumer spending that's actually getting tariffed. China's kind of like the biggest part of this, right? China's only 15% of our trade. They're the one that are getting hit with like 150% tariff right now. 15% of 10% of consumer spending is 1.5% of consumer spending is actually getting tariffed at 150%, right? So you can see how, like, when you really dig down into these numbers and you look at what percentage of the US economy is actually affected by tariffs, it ends up being a pretty small part of the overall pie, right? I'm not saying it doesn't matter. Again, I think negotiations and this stuff's like some of the most interesting part of geopolitics and the world right now is these negotiations around trade that are happening and have been happening since COVID. But from the context of like US GDP or our overall economy, it ends up being a pretty small overall portion. Okay. You add in the fact that we're the biggest buyer and we have a lot of leverage. My personal opinion, guys, is I think they will kind of get some deals hammered out here. I don't think it'll be 150% tariff on China forever, right? What does all this mean for US GDP? Okay, if you understand, hey, it's 70% services, there's only about 10% of consumer spending that's actually imported goods, and you sort of dial in and try to figure out what's the actual effect on GDP, the best estimates out there say, hey, this impacts GDP negatively, and just assuming every tariff goes in place and stays in place, right? Because we don't know what's actually going to be negotiated, so we have to assume the worst case scenario. Assuming all the worst case scenarios, GDP goes down by about 0.8% in the United States from these tariffs, right? It ends up being a very, very small overall impact. And it's because of exactly what I'm telling you guys. Most trade between North America is duty-free. Most of US GDP is not imports. Most of US GDP is domestic services, right? And so when you actually look at that minus 0.8% of GDP that's being forecasted, they're basically assuming that the uncertainty around tariff policy causes companies to pull back on investment, right? Which I understand the argument. I think it's a rational argument to make, but I think it's also rational right now to say, hey, the United States has a huge vested interest in rebuilding supply chains for itself. Went through the worst supply chain crisis in a generation during COVID. This is a major bipartisan issue. And we're already have seen factory construction in the United States triple in the past 2 years. I think it's just as rational to say, hey, a tariff wall is going up. It's just adding to the incentive for companies to build factories domestically. And you could just as easily see more of those factories be built, right? And more people be employed and wages go up. So I personally find the negative 0.8% to be overly pessimistic. I think you're starting to see the stock market reflect a lot of this. Like the worst case scenarios are coming off the board here. People, generally speaking, are looking at the situation with a little more sober mind. Big picture, guys, I think the U.S. economy I don't think we're going to have a recession from tariffs, right? I think we're going to have a recession, it'd be from significant cuts to government spending, and we cut like $1 trillion out of the budget in 1 year. That could have some short-term impacts, right? I think that those impact, we basically need to do it given where the budget's at. But big picture, guys, I don't think trade can crash the U.S. economy here. It's a pretty small part of overall GDP. And I think the market's starting to reflect that, right? The worst case scenarios are coming off the board. So I'll go ahead and end it there, Nick, with prepared comments. I know we want to leave some time for questions. I want to be respectful of everybody's time, but thanks for having me. And yeah, happy to address whatever's top of mind for the people in the audience.
Thank you, Bryce. Yeah, that's terrific. So I just wanted to pick up on something you said there because that was really interesting. Obviously, love the insight. Don't think the tariffs can necessarily lead to economic recession, but is it possible it could lead to some sort of corporate earnings recession? I mean, are we going to see company profits be dramatically impacted by tariffs and potentially having to pass on higher costs to consumers? Could we potentially see inflation come back? Because you mentioned globalization brought inflation down. Well, if we're going away from that, is it reasonable to assume that inflation might be back and higher than it has been in the decades previous?
Yeah, so great question. So the way I'd split up like the tariffs, like who pays for tariffs, right? That's a big debate.
Right.
The way to think about it, guys, is if there's like a market power component to it, right? So France makes great wine, right? And you guys make great wine in the Bay Area too, right? But France makes great wine. They're known for it. It's sort of like a luxury good, right? Maybe like Louis Vuitton purses or something too, right? They're really good at these luxury goods that there's not a lot of competitors in the market. If that starts gets tariffed at the border, I don't see that really impacting demand. I think most people are going to go out and be happy to pay those higher prices. And it gives the company the power to just basically pass through all the expanded costs to the consumer, right? Conversely, you see something that's more like commoditized, maybe sheets of plastic between like Mexico or Bangladesh, right? That's something that like if Bangladesh wants to keep importing it and maintain their market share, right, they're going to probably have to eat the whole tariff. They're not going to be able to just increase the cost because Mexico won't, right? So it really depends on market power. We saw this with like washing machines during Trump's first term in office. It ended up being about 60% of the increased cost of tariffs got passed through to consumers, and about 40% got absorbed by producers, right? So it sort of depends on the good. So I do think some of these costs are going to be passed through to consumers for sure. Now, will it cause inflation? Okay. Generally speaking, inflation is not caused by like tariffs, right? Inflation's a monetary phenomenon, guys. So one of two ways inflation happens is one, we print more money, right? That's what we did during COVID. There's like 5 trillion extra dollars in the economy, right? Or two, consumers' spending power goes up, right? They just have more money in the budget to go out and spend. So if you have the same like budget and you're deciding to buy imports that are more expensive, you just have to pull that money from somewhere else in your budget. So it's really wage growth that matters for causing inflation. And I mentioned reshoring. I think, cheap labor, right, has kept inflation low. It's because it held down wage growth for normal people in the United States because they had to compete with someone in China over the past 30 years, right? Now I think wage growth will probably accelerate. I think that keeps baseline inflation rates higher. But I want to be clear, like I don't think it's the tariffs necessarily that are doing that. It's the reshoring as a trend. Now tariffs are incentivizing reshoring, but you sort of understand what I'm saying there. So I do think there's just a higher baseline inflation rate in the United States now, and
Right.
tariffs certainly aren't going to alleviate that in any way.
Right. But nothing dramatically higher that would, be alarming for investors,
I
and
think
particularly retirees, looking to, navigate a comfortable retirement, right, Bryce?
Yeah, exactly. So like
Yeah,
instead of a 2% inflation rate,
yeah,
maybe now 3% is normal in the United States. That's kind of how
right,
I would think about it.
right. Very good. Great. Yeah, that makes total sense. As a friendly reminder for everybody, would love to, you know, hear from you. And if you have any questions, use that Q&A feature or go ahead and raise your hand and we can unmute you and you can ask that way. But now's a good time to ask your questions for Bryce. What do you think, Bryce, about the Fed? In terms of, and it sounds like that they're, kind of hands off, wait and see. They haven't done anything in terms of rates, lowering rates, raising rates so far this year. What are your kind of thoughts in terms of what, where we stand right now with the Federal Reserve and, what is it they're looking for, you think, before they do any actions?
Yeah, so basically we had this problem. They started cutting last year, right? And inflation was at 2.5%, which is, by the way, where it's at today. It fell a
Right.
lot this past week, okay, because we got like energy prices came way down.
Mm-hmm.
And so they started cutting interest rates, and basically what happened is the inflation rate bounced right back up to 3%, right? So then they had to sort of pause, and now they're paused again.
Right.
And so, hey, now that inflation's fallen back to 2.5%, and there's like concerns around the US economy and things of this nature, like I think the next couple of months are going to really matter a lot. Okay. So say I'm wrong, and like the U.S. economy slows down here, businesses pull back on hiring. There's negative impacts from this trade war that are material, and they show up like pretty obviously in the data. I think that's where you could see the Fed come in with like one or two rate cuts to basically say, "Hey, we're here to support the U.S. economy." I don't think they're cutting dramatically, but I think you could see a resumption of some rate cuts if we see the U.S. economy materially weaken due to this trade war. My personal opinion is I don't think we're going to really see that happen. I think they're not going to have like the evidence that they want to be able to justify more rate cuts this year. But certainly, even if they can move, it's going to be a small amount. It's not going to be back to the days of 0% interest rates, 3% mortgage rates, unfortunately.
Right.
And I do think baseline inflation, right? Even if we see, it's come down temporarily, right? My view is I think we'll see inflation head back to 3%. I think 3% is kind of baseline for the next 5 years or so in the United States.
Yep. Yeah, I think that's what we're thinking too here at Mercer Partners. And obviously, we do a lot of forward thinking and financial planning. And a big part of that is, making an assumption about what the long-term rate of inflation is going to be. And we're firmly in that camp too. 2.5%, 3%, somewhere in there, I think is a good barometer for, the inflation rate long term, right? Obviously it's
Yep.
going to go up and down in the short term, but I think we're both, in agreement there. I mean, obviously with you and your team at First Trust, the economics team, what is it that you guys are closely monitoring? Are there any kind of, indicators, any type of metrics that you're closely monitoring that if were to change, would kind of throw your, would alter your kind of take on things significantly?
Yeah,
Or
so I'd say, hey, if we see the labor market, for example,
mm,
weaken
right,
materially here, right? Like hiring slows down dramatically, or even like we see a bunch of job losses happen,
right,
that would be bad news, right? And
yeah,
that hasn't happened, right? Like we saw way above consensus labor market report, even though it was in the midst of Donald Trump adding all these tariffs last week. And it's amidst, by the way, a bunch of like federal employees being fired in mass. Still, we see jobs going up significantly in the United States, right? So I think
right,
like the labor market, wages, like consumer spending, any of these things would tell me, hey, things are weakening pretty quickly here. I think the other side of it would be, hey, inflation, like what happens with inflation. So I think inflation is going to stay like kind of consistently higher, but let's say they do all these government spending cuts and inflation falls below 2%. I'd have to like sort of reevaluate and say, well, maybe the reshoring thing isn't actually inflationary at all, right? Maybe based on inflation, like AI or automation or something's kicking in and saving us in that situation.
Right. Yep. And I know you mentioned earlier about, there were a handful of stocks, that were really driving the market, the Mag 7, right? That were really, um, in your opening comments, it was interesting because you said basically you thought that the market was overvalued coming into the year, right? And that the tariffs were the catalyst. So, I mean, is it safe to assume then if it wasn't tariffs, there probably would have been something else that potentially could have set off the market and caused a correction or a pullback? I mean, it just so happens tariffs was the kind of headline du jour that everyone focused on and caused the market to reprice. Does that sound right?
No, I think that's
Yeah.
dead on. We
Yeah.
forecasted 5,200 in December of last year. Now, I mean, I'm just being honest, like it got there way faster than I was expecting, right? But
Right.
just
Right.
generally speaking, the market looked overvalued. It was overvalued because of a small core number of stocks. And so I think things are just priced to perfection and things are never going to be perfect, right? There's always going to be
Yeah.
some type of uncertainty. And especially like Donald Trump's been reelected, right?
Yeah.
People have varying opinions on Donald Trump, but he always like kind of shakes things up and disrupts the status quo. I think that's
Yeah.
kind of baked into the cake with him.
Have you been keeping an ear to the ground, so to speak, in terms of what's going on with the Trump administration and like tax policy and tax reform? Is that something that we should be expecting some announcements? Is that the next kind of frontier for the Trump administration in terms of legislative changes?
Yeah, I mean, they want to extend the Trump tax cuts that exist. When I think it's this year they want to do that, right?
Uh-huh.
And so I know there was just a bill that was passed, like an omnibus bill in the House, that basically didn't require spending cuts to happen in order to extend these tax cuts, right? Which upset a lot of people because, obviously a lot of Republicans want to see government spending get cut. And so if you just blow out the deficit, hey, you're going to have problems, right? So I think the question is, hey, can they actually find places to offset the spending elsewhere, right? Does
Right.
Doge actually cut enough spending to offset the Trump tax cuts? Or is that something that we just kick the can down the road on?
Right.
And I know Doge, by the way, can't cut anything themselves, but
Yeah.
uh, next year they're supposed to submit their recommendations. I don't think the Republicans are going to wait till next year before they try and extend these tax cuts. And so my worry is, hey, they extend these tax cuts without paying for them. Now, maybe like tariff revenue, right, could offset basically the entire Trump tax cuts here, unless he's like adding a bunch of new stuff that we don't know about.
Mm.
But I think ultimately we need to see some spending cuts happen because the
Yeah.
reality is the government budget is extremely precarious right now. And if we're going to become more self-sufficient and like try and reduce the trade deficit, for example, right? A
Right.
lot of demand for US Treasury debt came because, we buy more than other people buy from us, which means we send a bunch of dollars abroad, which then investors abroad invest in US Treasury bonds, right? So if the demand for US Treasury bonds is going to disappear from the foreign sector, like we actually need to cut the deficit uh, to make sure interest rates don't surge even more. So I think cutting spending is like extremely important here.
Yeah. Right. We've been getting a lot of questions or some questions from some of our clients, Bryce, around Social Security. And I want to be very clear because I haven't heard anything come out of the Trump administration that they want to touch Social Security or any entitlements for that matter. In fact, I've heard that he wants to not tax Social Security income, or at least that's
Right.
on the table. Is that can you put some of our clients' minds at ease? Is that what you're hearing as well? I mean, there's nothing in the plans that Trump is trying to take people's Social Security income and that you've heard, correct?
No, yeah,
Okay.
he's talking about not taxing Social Security income. From what I
Right.
can tell, I think a lot of this comes from like, I'm sure like Elon Musk at some point has called it a Ponzi scheme or something, right? Just referring to the
Yeah.
fact that people need to constantly be paying in more than it's getting taken out. And like
Right.
one of the reasons we have problems with Social Security in America, right, is just that people started having less kids 30 years ago and they're living longer today, right? And
Right.
so it creates this mismatch of people taking money out versus putting money in, and the system's in deficit. But I haven't seen like any real proposals to actually cut Social Security.
Okay.
And it's like Elon Musk, I think he called it like a Ponzi scheme at some point. I think he's talking about like 150-year-old people that are receiving Social Security checks or something, right? But
Right. Right. Yeah.
I just from like a concrete perspective, I don't think there's any will in Washington, D.C. to cut Social Security. I like to say AARP is like the biggest lobbying group in America. That's the
Right.
reality, right? It's
Right.
it's the third rail of politics for a reason.
Right.
Older Americans go out and predominantly vote and elect people. So touching Social Security benefits is basically political suicide, from what I can tell.
Yeah. Yeah. That's what I've always thought as well. But yeah, for sure. So, is there, if you had, one piece of advice for folks that are, maybe approaching retirement or in retirement, given all the kind of turbulence we've seen, in the recent weeks, and perhaps what's in store, right? It could definitely be, more turbulence ahead. We don't know the future, but if you had one piece of advice to give folks, what would that be?
Um, Man, I'd say if you're retired and you probably have some more time to watch the news and follow along with all this stuff. And unfortunately, I just think like a lot of our media ecosystem's geared towards like keeping people really upset and engaged because that's how you sell a lot of commercials. And
Right.
um, man, I just feel like it's not a great way to spend retirement, right? Being frustrated all the time. And I think generally speaking, guys, like America has so many natural advantages. Like we're going to be fine here. I don't see anything with this correction that's like outside of statistical norms. I understand that Donald Trump's like an upsetting figure for a lot of people, so I don't want to downplay that. I think people are absolutely allowed to have their opinion of him that they want to have, but generally speaking, the U.S. economy seems fine to me. I think we're in a position to kind of weather the worst of the trade war situation. We have the most profitable companies in the world, the best innovators, the best demographics, two oceans, two friendly neighbors, the most food, the most fresh water, the most energy. Like we're going to be fine over here. I almost guarantee it. The only thing I could like beat America is like America, right? Is like tearing ourselves apart from within. And I think
Right.
just the economics of the media ecosystem, like how they make money, I think is a big part of that. So I try to stay away from politics, guys, and just give you the hard data. I'm telling you, there's a lot of reasons to be optimistic about the direction the United States is heading, even despite politics and everything else.
Well, Bryce, I think that is a wonderful place to leave it for now. Thank you again for joining us and offering your fresh perspective and insight. It's only always appreciated. I'd love to have you back. We'll reach out to maybe see if you can make that happen for your schedule. We love having you. Every time you engage with our clients, the feedback has always been terrific. So thank you once again for the terrific partnership and for your time. I know you're in Austin, Texas right now, so
Yep.
you guys, your football team there, your alma mater, the Longhorns, had a good run this past season. So hopefully they can do it something like that again. My son plays for the Longhorns right now on his
Oh,
youth football
nice.
team, for his youth football team. So
That's
it's kind of
awesome.
cool. Yeah.
All right. Well, yeah. Well,
Well,
thank you for having me. I'm always happy to do it again. You and your clients are awesome, and have a great day, everybody.
thank you so much. Really appreciate it.
See you
Thanks,
guys.
Bryce. All right.